Alright, so tonight we will be talking about trading the Last Kiss Breakout. I know a lot of people were liking this strategy and wanted to kind of understand it a little bit better, so we decided to go ahead and do a webinar discussing it so we can lay out the rules and all that sort of thing, give you some examples. Welcome again to everyone for joining us. This is our usual Tuesday night free webinar series. Good to see a bunch of regular people in here and some new faces as well. For those of you who don't know me, my name is Nate McGee, the Forex guy here at Microquant, and hopefully we'll have a little bit of fun tonight, show you some of these examples here, and hopefully you'll be able to use it. As usual, you can submit all your questions via the GoToWebinar menu on the side, and I answer those throughout the webinar for the most part. But if it is a lengthy one, then I probably will answer it toward the end, but usually we can answer those right away. Of course, we have to go through these risk disclaimers here that I'm sure you've all become used to seeing here. So we'll just go ahead and get right into it here. Trading or investing carries a high level of risk and is not suitable for all persons. Before deciding to trade or invest, you should carefully consider your investment objectives, level of experience, and ability to tolerate risk. This content is subject to change at any time without notice and is provided for the sole purpose of education and assistance in making independent investment decisions. ValueCharts.com has taken reasonable measures to ensure the accuracy of the information contained herein. However, ValueCharts.com does not guarantee its accuracy and is not liable for any loss or damage which may result directly or indirectly from such content or from an inability to access such information or any delay in or failure of the transmission or the receipt of any instruction or notification in connection therewith. Any past performance results are shown for illustration and example only, are hypothetical, and as such have many inherent limitations. No representation is being made that any account will or is likely to achieve profits or losses similar to those shown. Past performance is not necessarily indicative of future results. And of course, we have to go through the CFTC Rule 4.41, which is the hypothetical disclaimer. And as you know, or some of you should know anyway, it's just saying that everything mentioned in this presentation is a hypothetical because it has happened in the past. Therefore, hindsight is always going to be 20/20. And as you saw before, past performance is not necessarily indicative of future results. And this will kind of affect us tonight because I will be showing a bunch of examples here, and they actually will be going in TradeStation and looking over some live examples. If you have any questions about the disclaimers, as usual, you can go ahead and email us at support@microquant.com, and we will get those over to you if you want to talk about them or anything like that. Tonight's webinar will be discussing the background information of breakouts, what they're for, how to use them, some of the phases of a typical breakout trade. Yes, Mike, I will send these out to you as well. To everyone, I will be sending out slides. So don't worry about taking notes. Just try to absorb it all in because we'll go through it. It's not a lot of information, but we will go through a few examples and all that. And then we'll actually pull up TradeStation and look at the stuff live. We'll also discuss problems with the breakout trades, discuss the rules that follow the last kiss. I'll show you a bunch of examples, a little Q&A if you have any questions, and we'll go to TradeStation to show examples if time permits. And the Q&A, we can also do that all throughout the webinar. So if you have a question at any time throughout it, just let me know. So we'll go ahead and start here, give a little bit of background information first about all this. So the market has two moods typically. Sideways directionless market, which is just a drifting market. You'll see that a lot now, especially in the currencies. And of course, you have a strong trending market. Some people will break these down. You have a market that move up, down, and sideways. A shortened version of this is just here. Just two ways, sideways or in a trending market. Typically, any trading system or strategy will work in either a trending market or a sideways market, but rarely will a strategy work in both of them. Okay, it's all about using the proper tools for the trade. If it's a trending market, your breakout trades probably aren't going to work, and likewise on the counter. The breakout strategy. This is the go-to strategy for finding that transition of a chapter market to a trending market. So this is really a really powerful tool, actually. If you can get a good breakout strategy to use, it can really help you out. There are typically two phases involved in any breakout strategy here. Wait for the market to consolidate, which is just that sideways movement, or if it's getting really choppy. There are people that are solely breakout traders, and it's worth knowing that a breakout trader is definitely a patient trader. It's a good characteristic to have, especially when you're trading, to be patient and not over trading or just rushing into decisions. The people that do the breakout trade solely, they're definitely a disciplined, patient trader. And then the phase two is just entering a trade when the market breaks out of that range, that tight consolidation range, and shoots off in one direction or the other. And depending on your trading style, usually you'll catch a quick profit, whether it be to a profit target like a quick zone or a support resistance level, or you might possibly get an early entry into a strong trend where you start finding these tops and bottoms of the market and they start consolidating before they break out the other way. So the first phase is, I like to call it consolidation. What you got to do is identify that transition between that uptrend or downtrend and how it is about to change into a sideways movement. Now, as a breakout trader, you need the skill of identifying that transition. If you don't have that, then it's kind of hard to do breakout strategies. Is it possible to really find that, have that little edge of finding when it's about to transition? And really the answer is yes, and here's how we're going to do it. You want to draw a box around the market activity that has all of the sideways movement, and there's 3 rules to follow here, really. Your box must be drawn on both support and resistance. It can't just be support without any resistance. It should be very, very obvious on the chart where it's at. You shouldn't be having to tilt your head sideways to try to find it and see if it is a consolidation zone. It should really just stick out like a sore thumb in a sense. And typically, there will be several touches on each zone on both support and resistance. You want about 2 or 3 touches on each side of it. Okay. Consolidation can, in fact, last a while. I like long consolidations for this strategy. The more consolidating it does, the better it is for me. I don't like the short consolidation because sometimes it isn't as big of a move, I should say. So whenever a market breaks out towards a support or resistance zone, that's whenever we're going to be taking notice. We're going to trade it a little bit differently than most breakout traders, though. The trade is not entered as soon as the market pushes outside the zone. Most breakout traders will typically place their buy orders above the resistance zone, or they'll sell orders right below support in anticipation of that breakout, then enter the trade, and then hopefully they're in early on that move. And we'll talk about some of the issues here in a second, but many breakout strategies exist out there, but really the core concept of any breakout strategy is once the market breaks out of that consolidation, enter a trade. That's really the core concept of almost every breakout strategy, even though they all have different variables for entering and things of that nature. And like we said before, identifying the transition is a key skill needed for any breakout trade. If you can't identify that, you won't know when a breakout's going to happen and when you can catch a big move to the upside or to the downside here. And you probably won't know why your trend trading strategy is failing all the time, because you're not identifying a transition between trending and consolidation. So what is the issue with most breakout strategies, and why is this last kiss trade a little bit different than everything else? Well, if you've ever been in the market too long, you know one of the biggest issues is a fake out. What a fake out is a move outside of the consolidation zone, which appears to be a breakout, but instead of continuing on, in one direction for that strong trend, whether it be the upside or downside, the market actually retraces back inside of that consolidation zone, which is a big no-no, and really is frustrating. It's the biggest pet peeve of breakout traders. It's my biggest pet peeve, especially when you get stopped out like at a high tick or a low tick, or you sell at the very low, that sort of thing. It's really frustrating. It's the biggest problem really with most breakout strategies is not being able to understand or know when a fake out is going to happen. So the solution is this last kiss strategy here. This breakout strategy is designed to avoid the fake out. All right. Many breakout signals really do, they do offer good trading opportunities, but others not so much. All right. The fake outs are really the primary reason why traders find it difficult to consistently apply a breakout system or strategy, because a lot of times they're just wrong too often. And the reason behind that is, if you ever ask anyone how much does a market trend, 9 times out of 10, if you've been in the market for a long time, it varies between 15 and 30%. A lot of times markets are just sideways. They think they're in a trend, but they're not really in a trend if you look at maybe larger time frames. So the markets aren't really in the mood to start a new trend. That's why fake outs happen. They try to get pushed up or pushed down, and then they decide, nope, not ready for it yet, and go back into it like a stubborn child. That's all it is, really. The retouch principle is one of the key concepts here in technical analysis, and in this strategy, the retest principle for support and resistance. So the market will trade beyond the zone before returning back to the zone from another side to confirm the importance of the zone. That's really that's the retest principle. When you break through a trend line, a lot of times they come back up there to retest it, or come back down to retest support level, that sort of thing. That's the fancy way of saying it. But in other words, if it's a significant zone, a lot of times the market will come back to retest it in order to verify how valid that zone is. So why are we doing it differently? Why are we waiting so long really for this breakout? Like, we don't get on it right away. We wait for it to come back up, which could take days depending on what time frame you're using. It could take hours. It just can take a long time. Why is it all about this patience? Well, we'll kind of show you some examples. Look at them in the live charts as well. But if you look at any fake out, really, when they do pull back, they really pull back inside quickly. That's really one of the key characteristics of a fake out. It'll pop out, and sometimes it'll just come back inside of it on the same candle or in one or two candles. That's a fake out. And that's really the key concept for this last kiss. We'll touch on that later. But true breakouts, those that continue to travel after the breakout, they come back that significant zone once they have pushed way beyond the zone. That's really it's a tendency, a psychological tendency that happens all the time in the market. So we wait so that we can confirm that the market will truly respect the boundaries of that consolidation that we set. And if it is respected, then we can assume that, hey, everyone sees this, everyone doesn't want that price to go back that level anymore. So we need to get in that direction, the new trend. So not every breakout trade is a last kiss trade, but every last kiss trade is a breakout trade. That's really the concept we're going to try to apply here. So entering the trade. Are we good so far? We can pause. Like I said, it's not going to be a lot of information, I guess, on it. We'll just kind of cover the basics of the difference between this one and other breakout trades and the psychology a little bit behind it. Yes, we will touch on that. Retouch, not always. To touch on what, it'll be a support or resistance zone. We'll show that in a second here as well. Correct, Mike. So the one issue you're going to have with this is you may miss some of those breakout trades that break out, okay? But the amount of fake out you're going to save yourself from could outweigh that. If you don't want to use it, you don't have to. This is just a filtering mechanism, really. This is the ones I prefer to use. It's just, that's my personality as well. So it's really however you want to use it, if you want to use it for that or not. All right, so entering the trade. You know how to trigger this trade here, so we got to trade the retouch. Whenever the market returns to the edge of the consolidation box, it must print a strong candle in the direction of that breakout. So if we're breaking out to the upside, it must be a strong bullish candle. And how we enter here is we put a buy order above the high of that bullish candle. So we got to make sure that that candle does indeed close out. And then we'll put in an order like 1 or 2 ticks or pips above that high so that we force the market to push through that level in order to trigger the trade, as opposed to just entering at a market price. Because sometimes, especially in the futures market, prices are respected so well to the tick every single time that they won't go past it sometimes. And if they're not going to move higher, then we just save ourselves from another fake out, potentially. It's just one more filtering mechanism. Same thing for a downside breakout. It must be a strong bearish candle, and a sell order is going to be placed below the low of that bearish candle. And I put this all in bold for you. Do not enter the trade before the candle closes. It's not enough for that market just to touch the zone and to pause. The market must print that strong candle in the direction of the breakout. Okay, if you enter in early, you could be really shooting yourself in the foot for this. It could close out a doji. It could continue moving down into an engulfing candle. Who knows? It could just go a lot of ways. So you want to make sure that it closes and fully prints so that you know. Brad, the question here is what time frame are you talking about terms of candles? Brad, is any time frame. Large time frames have humongous moves. Small time frames, not as big as moves. The examples I have are on weeklies and monthly charts, but I will also show you them at the end of the webinar. We'll go on TradeStation and pull up some smaller time frames. We can try to look for some. We can pull up markets that you want to look at, and we'll see if we can identify some. Time for that seems to work better than the other. I like 4 hours. I like the 4 hour chart just because it's good enough to get maybe a couple of trades in a week. That's just me personally, though. That's my style. Alright, setting stops and profit targets. There's going to be 2 stops for this trade here. There's an emergency stop loss that's going to be placed in the middle of your consolidation box. And when we go to TradeStation, I'll show you how I draw them so that you'll get a feel of how to do it. It's not an incredible science behind it. It just takes a few times doing it. You should get used to it here. But this emergency stop loss here, this will rarely ever be hit. I've never had one hit in my entire life. It's never been hit. So what it's worth noting here, though, that the risk reward is very, very bad. So if you're all about risk reward, then you'll probably lose sleep at night with this stop here. That's what that stop is there for. The emergency stop loss is for nights when maybe you are going to sleep in the last kiss. It's the worst possible case scenario. You know, if you're doing a 4 hour chart, that could be 24 hours. If you're going to sleep 24 hours, hey, you might get hit out. That's all it's there for. This is how you identify this area here. So you track the resistance level zone from the support level zone. Record that number of ticks or pips, whatever you're doing, or points. That's the height of the consolidation box. Divide it by 2. Typical averaging. Then add this amount to your support level, and that's where you put your stop at. So that's just one of the stops, and that's going to be in case, like I said, you're going to sleep or you went away from the computer for a little bit, and you got the gym, something like that, and something crazy goes in the market like FOMC. That's when it's going to be hit. But like I said, I've never had my emergency stop loss ever hit. So it's very rare. Then you have a manual stop. If the market ever closes back inside of your consolidation box after the trade is entered, then you exit the trade manually. This will definitely be a much smaller loss than the emergency stop loss. So it's definitely an attractive sort of characteristic about this sort of setup here, where the average losing trade is very, very small compared to a typical fake out where you might enter in and then lose a whole lot. This one, it keeps it pretty minimal. And the reason why it's a manual is because sometimes prices may shoot back into your box, your consolidation zone, but it won't close inside there. So that's why it's a manual. For taking profits here, it's just really the next support or resistance zone. That's the easiest place to really exit. You close out entirely or take half profits and put in a break even and stop letting it run. I mean, if it's a small time frame, I like just closing out entirely. But on a 4-hour chart, I usually have 2 profit targets. When I hit my first one, I take off partial profit, break even, stop, and let it run my next one. So that's pretty simple. Now this will just be a quick summary of the steps of it. Then I'll show you examples. We'll have a quick Q&A if you have any. Then we'll shoot over into TradeStation as well. So basic, here's the steps. And again, I'll send these slides out to everyone so you don't have to worry about writing these down. It'll just be the quick summary of it. Now, kind of diagram these when we're actually looking at examples here. So you wait for your price to consolidate in a box between 2 zones. And this box should have at least 2 touches on both zones, support and resistance. You want to wait for the price to break out beyond one of the zones. And we will see breakout, it will continue on down. Unless it's a fake out, then pull back in, you're not going to enter the trade anyway. Once the price actually does return back to the consolidation box, you want to wait for the market to print a last kiss candle on the edge of the box. So it's either be a bearish or bullish candle depending on which way it broke out. But for shorts, a sell order is going to be placed below the low of the last kiss candle, and longs, a buy order is placed above the high of the last kiss candle. Emergency stop loss is placed in the midpoint of the consolidation box. Profit target is a near zone. And for those of you, some people are asking about support and resistance. Support and resistance, we have a webinar about that actually on YouTube. You can look at that. It's a technical analysis intro. Basically any area that, well, I'll show you here in a second. I'll show you in a second about support and resistance. So we're good so far. I can show you some examples, and then we can have a Q&A as well after that to get the idea of what's going on. We're all good? Okay, a lot of people are good. Yeah, we'll talk about that in a second as well. All right, here we go. Soybeans. And the concept behind these trading strategies really is all about trading pure price action. Who cares about indicators? This is all pure price action. So I'm not going to put any of our indicators on these charts. And I want you to see if you can identify anywhere that is consolidation. Just blurt out a time or a rough time on the bottom there if it's between certain years. All right, we got a few different responses here. 11, yep. Okay. Yeah, we got 113, yep. 2011, 2012, yep. All right, good deal. So, what I do first when I do any sort of chart, a lot of people that are in the trading room, they know I do zones. So in order to find my zones, I always pull up that line chart to look for the most bends and find my support and resistance. So right here, I went ahead and drew them out. And for those of you asking, this right here is resistance because prices couldn't break above there. So there's some sort of pressure there that people don't want price to go above. And then for support, it's all this right here. People don't want to go any lower than this. They're pushing the market back up, so it doesn't go below that area. Whenever resistance is broken, it becomes support, as can be seen over in here. And whenever support is broken, it becomes resistance. So that's one of the basic concepts of technical analysis. Again, if you have problems with that sort of stuff, there is a webinar on YouTube uploaded on our channel, so you can get a brief overview of that. But so this seems like pretty valid support and resistance zones. Again, there's no indicators here. We're just looking at where there's a lot of bends here, a lot of bends, good bit of bends. You can see there's a good bit of support and resistance. Pretty easy to identify once you get the hang of it. Okay, so then we go back to our candlestick, and there we go. I drew a box around that zone, and you can see we have a few touches here. We have two touches right up in here, touch right in there, right in here, right in here. This is considered a touch. That's a near miss, but it's still considered a touch. Okay, and when you see this, how prices are coming down, this is a breakout toward a support zone that we kind of mentioned. You start to take notice, okay? Sure enough, it does break through. There's no fake out here. Okay, it does pull back inside a little bit, but you can see it still continues to head on down. So waiting for it to come back to confirm how valid that zone is. Sure enough, it comes back up, touches it right there. And I would say that's closed out in a pretty strong bearish candle. It closed out near the low of that candle. And then you would experience a little bit of drawdown here. Looks like 768. We've had a little bit of drawdown, not too much really. But then it continued to come on down, and I usually get out of the next zone. I usually give myself a little bit of breathing room, 20 ticks, 20 points, like that, depending on the time frame. On the weekly chart, I'm going to give yourself a little bit more room for that profit target. Okay, sure enough, it came down there. Would have been awesome. And we also said there's another zone at 2000. You got 11, 12. We got 12, 13. Yep, we got 13 over here. So if you got that one, good deal. We have 3 touches right in here. Pretty nice 3 touches. We have 1, 2, 3 roughly right in there. 4 fake out. 6, 7. These right here touched as well. And you can see it broke out above. You know, again, if you got a breakout trade like this, hey, you got a good signal. It went up. Okay? But if you want to get in at a cheap price, look what happened over here when it came back down, touched. And obviously still will. Right here, this is going to be an issue with some people, I guess. When they put their buy order above there, they're at the next zone already, so they're not sure about the risk reward. I would have still taken it because I'm at the next zone. I would have taken it so I could ride up toward the next zone up here. But again, I mean, it's really just that filtering mechanism. If you were a breakout trade that broke through the zone right here, there's your fake out that you would have gotten hit on and pulled back inside and you would have lost out. But you can see here's that typical strategy that you're looking for. You want to see it break out toward some of that resistance. It's a lot of bullish candles there. Over here, a lot of bearish candles that come down to that area. It's just something you want to start taking notice of. Doesn't mean it's going to break through. Nothing's ever guaranteed. But, and again, that concept as well. You don't want to just come here and pause. I'm not going to put a buy order right there on that doji. That's not for me. I want to see it do a bullish breakout. So I'll wait to see if it's going to actually do that. If it doesn't, I'm not going to get in it. It's all about patience, patience, patience. And we got one more on here. We had a couple people that found it actually. We're over here. Not as easily seen, but still a breakout zone. It's still sideways. Okay. Yeah, plenty of touches up here at the tops. Right in here. You have a lot of touch down here when it started. Again, right here, right here. That typical bullish move to the upside. And it broke through. Came back down, bearish candle. Then it came down and touched right inside that zone, which is pretty nifty. And then that's a perfect textbook strong bullish candle. That thing closed at the high. That's what I want to see. Put my buy order a couple of ticks above that. Have it go ahead and come up here, partial profit, put a break even stop in, see what happens, and it does continue on to run back up there to the next zone, and then it consolidates a little bit more, then it breaks back down. And that's how it goes in the markets. They move in a pretty predictable pattern if you can kind of visualize it. Once you start drawing these boxes, sometimes you can really get an idea of what's going on. And I want to show you something else pretty nifty here. Some of you may have noticed it, but let's go ahead and extend these zones back out a little bit more. We'll extend this zone right here out, and you can see last kissed one more time, and that thing has just been going like there's no tomorrow all the way up there. Extend this zone out, you can see it came back inside the zone for a little bit, pulled back inside, then it did break out. Then what happened here? Okay, came back down to our zone yet again that we had drawn, and basically triple bottom right here inside the zone, then also broke out one more time. So that's soybeans likes ranges for you futures traders, just a FYI. The next one, this is our 10-year treasury notes. Alright, so I'm going to do the same thing here. I'm going to draw my zones right quick. Line chart seems about right. Have some decent zones drawn there. This is the weekly chart again. Now, where are the zones? Just a couple of year ranges roughly. If anyone can see the areas of consolidation on it, good for you. That's what you're looking for. Alright, getting a bunch of 13s. You are correct. 13 is where it's at. This is very recent too. These are taken all today. So I know Thomas is saying in trading room that he's bearish on the 10-year. Here's a good validation for it. Sideways movement, massive amount of touch. These are the touches I like to see. I like to see all these touches here. I like to see a good bit of fake outs too. When I see 3 or 4 fake outs, I like those because it lets me know that this is a pretty powerful force behind it. Like, it doesn't really want them to move down or up. It's a really key area. So we have fake out here, nice fake out here, but again, that's the characteristic we want to see, where it pulls back inside there quick. And that, I mean, it took a month, but it still is quick on a weekly chart. If you see a pull down inside there, anywhere between 1 to 5 candles, really, that's a pretty quick pull back inside. And it had that usual breakout toward our resistance zone. Right here, they weren't sure about it. This was the last final call. They're like, I'm not sure if we want to do it. Fake out. Close that pretty bullish. Thought I was going to stay in the zone, but then sure enough, it broke way down to the downside. And again, it's a pretty big move. So a real breakout really does continue running. And then a lot of times, it comes back up to retest the significance of that zone. And that zone was significantly tested. As you can see, there's so many touches here. Psychologically, they're trying to pull back up there, see if it's going to be respected, and it is very well respected. So they pulled back down. That was a very strong bullish candle. You can't really see it. It might pull it up on that live chart. So yes, I would, if I saw it. If I saw it, I would have entered in. I'll wait the whole weekly bar, yeah. I'll wait a whole week. It's all about that patience. So choose your time frame wisely. But yes, I would have entered in right there. I put an entry right below that low. When prices go through it, you know, I would have rode out until hit the next zone, which I already had drawn over here. So I would have hit my profit target to the tick. And that thing right to the tick. Close it out properly, because the risk reward wasn't like a huge one. But if we saw a breakout from like right here, yeah, that's gonna be a humongous nice risk reward. That'll be a nice one to hold on to for a long time. That makes sense? Yeah, it's all about the patience. And like I said, the longer it's going to be in that range of consolidation, the more I like it, the more I pay attention to it, the more fake outs I see, the more I'm getting ready to trade it. And of course, it's gonna be hard seeing it move down, and that psychological awesomeness, you want to call it, where you want to ride the herd and you have that fear of missing out. Sure, I mean, like I said, a breakout trade, this could be a good signal, but you still got to run a risk of possible fake outs like this. I'm not saying to get rid of your breakout strategy, but most breakout traders know that there's a lot of fake outs. So this would give a good signal. Good job. But at the same time, we could have gotten right back in it again at the same price, roughly. Yes. So one has to be prepared to wait a year for a breakout. Correct. And I will show you one that I'm actually watching. I'm actually watching one that's been trending for months. What lines did you add to the chart to see support and resistance? I just drew them myself there. I just looked for bends. I took a line chart out there, and then where I see the most bends at, that's good support and resistance. So I just drew them in rough areas. That's all. So again, it's for profit targets really, to measure where profit targets could go to. And since line charts on the close, it gives you a little better idea of where prices actually do find resistance. So like right in here, we touched it right up on that, but you can see there's a big wick to the upside. So it filters out some things and gets you a little better idea of how to find support and resistance. All right, that being said, are there any other zones anywhere? I use fibs occasionally, yeah. Not all the time, but sometimes I do, yeah. Are you selling buying on these touches, is what you're saying? I am selling once they touch or almost touch and then close. If they close out like toward the low or close out toward the high, I'll buy or sell. 0, 9 to 10. Oh, there we go. I didn't know if anyone's going to see that. Good job. That's a good one right there, but I wouldn't have ended it on this trade. You can see it pushed back inside of there. Like this, the first part of it. We'll kind of explain a little more here, but we had plenty of touches. Okay. Nice touches. It broke down like it usually does. And, you could have gotten in your typical breakout trade, no problem. Would have got faked out. Hit your next zone, no problem. Pull back up. But it went back to that zone pretty deep. Okay, which is fine. You probably wouldn't have triggered the trade anyway. However, you still can trigger this trade because you're not in it yet. You're not going to close out of it unless you're triggered in the trade and it come back inside and close inside of it. That's when you want to consider exiting. But since we're not in the trade, we still could have taken a short right here. That's no problem. And could have gotten on it. Some would call this a fake out. That's no problem, but I don't really consider it a fake out because if you look right here, we extended it again. It just did break down. This could be like a monthly candle fake out. Comes back inside the zone again. Has a nice bullish breakout upside. Hits both profit targets. No problem. Comes back down and then again touches. And this one right here, even though it didn't, that part isn't touching the zone. It's still in the zone area. Remember, the zones are just beer bellies of the market. They're not exact prices per se. They like being tested. It's that hot burner that your mom says don't touch it. You're like, I'm going to see if I really can touch it, until you learn your lesson. You get burned all the time, and it's a memory. That's like that psychology of the market. They're going to see it. Okay, I wonder if I'm going to get in trouble for coming home late tonight. Let's see if I can push the boundaries a little bit. That's what each zone is for. Psychology is like, can I actually push back? Can we make it higher prices? Can we make it lower prices? So they miss it sometimes. Sometimes they go really deep into it. So once you get used to it, get the hang of it, you'll know really what the characteristic is. You'll know if it's a last kiss or not. So right here, it came right down to the zone. I would have taken that trade, put a buy right in there, no problem. And it would have hit profit target 1, 2, and yeah, it just kept on going. Now, here's a big one for Forex guys. Aussie Loonie cross monthly chart. Yeah, I'll show you my line chart here. There's not a lot of data here. It's only, this is years worth of data. It's from 2008. That's all the data there is. So we got a good a good bit of data, about 6 years or so. And there's my zone. I'm waiting for this month to close out, man. I want to see what's going to happen with it. This is my zone. Drew it right across all these. There's a lot of touches on there. A lot of touches up in here. We had a breakout. And now we came back inside of it. It hasn't broken back inside of it. But I'm definitely watching this. If you're a Forex trader. Yeah, you got a ways to go. Got a couple more weeks for this one to see what happens with it. Alright. Any more questions? If not, we will pull up TradeStation and I'll start showing these things live. We can look at market. Do you want to look at time frames you want to look at? If you are asking if this is a breakout trade or not, or last kiss range, I can look at it and verify or not. Let you know how I would trade it. That sort of thing. So questions, let them fly. If not, we will go on and get into it. Oh, sound check? Must have cut off. Sorry. Do we have... I do not have any stock examples. Sorry. I can look for stock examples though. I can look up any stocks you want. I think I have those feeds. No sound at all. Was about a minute. Okay. ES. What time frame do you want for ES? Look at Apple. I'm sure I have those. Let me just double check here. Okay. Oh, copper. We'll look at copper. Okay, MSN, what do you want for ES? Like what time frame? We'll look at that and see what we can find, and then we'll look at Apple, then we'll look at copper. ES in the 3 minute. Alright. Let's see what we got here. Yeah, that's a tight range. I mean, I would draw that. No problem. I would just get my charts right here. Yeah, you're just waiting for that thing to break out. That's all you gotta do. Actually, it's worth noting. I'm gonna pull up. I'm pulling up the dollar yen here on the 5 minute chart. I just before the webinar started to see what's gonna happen with it. Here's my original zone. I was going to try to get a live example of this so I can show you how I trade it if it does unfold. So there we go. Good bit of fake outs here. And now just watching for the dollar yen to come back up to it. See what it's going to do. So we'll come back and check on this in a few minutes. Okay. We're looking at Apple. What time frame for Apple? No problem. $15. All right. This one, not really sure. It's making, yeah, it's lower highs. There's no doubt there's a good bit of support down here, though. That's for sure. Definitely a good bit of support down there. Right now, that's more of just a trend line thing. So I wouldn't say there's anything on that right now. But if we look at, pull back out to it like a 30. Actually, let's look at a 240. Yeah, there you go. That's what you're looking for here in the 240. So there you go. That's what I'm looking at on the 240. This right here is a fake out. See that pulled back there quick? Tried again, pulled back inside so quick, and it just stays in there. This is what I'm looking for. These highs are a lot more valid than these highs. So what you watch for this is possibly for this to break the downside on here. Yes, AJ, the recording will be made available. What else? We got good sound. Okay, Apple. Let's look at copper. Okay. What time frame for copper? Look at copper. Let me write these all down right quick. So we need to do euro daily. YM 133. What time frame for Google? Okay, Google will look at 4 hour. Crude 1 hour. 1 hour. 30-year bonds 4 hours. US, look at 4 hour. PCL in 5 minute. Okay, cool. Got a good bit of those to look at. We got about 1, 2, 3, 4, 5, 6 markets to look at. Do I prefer one time frame over the others? I like 4 hour charts a lot because it's enough. I'm just patient enough to wait on those time frames, and the moves on them are pretty big. You can do them on any time, any market, in any time frame that has people involved. You can trade this strategy. It doesn't matter what asset class or. So we're looking at copper on the 4 hour, correct? Okay. Copper on the 4 hour. Yeah, I was actually looking at this today, actually, because I'm trying to get in on it. Actually, see what I have drawn here. My future stuff. See, on copper, on the daily, I need to draw it better. Let me pull it up on our regular space. This is what I'm looking for. So that's what I'm watching for here. I'm looking at the 4 hour chart, no problem. But I'm watching copper more on the daily chart to see what happens. It's already broken down. You can see it's starting to get a little more bullish here. We had yellow tip. It's hard, we wouldn't call it doji. It's more a spinning top, but you can see it's starting to pull back up a little bit. I'm going to watch if it's going to touch that or not. But for the 4 hour though, I will look at that. I don't think I see anything on there off the top of my head. Looks pretty good though on 60. Yeah, I mean, this could be, you can argue this is definitely a fake out. I would put this right there where it actually open and close right in this area. Fake out there, and this was a nice fake out that popped back inside pretty quickly. So that's my range right there. Waiting for that to break out. Looks like we had a nice one over here actually. And there you go. Look at that one. That happened earlier. There you go. That's a good one on the for our chart. Okay, let's see what's next. Euro on a daily. What euro do you want in the daily? EC or Euro USD? We'll look at EC, I guess. Euro future. Okay. Yeah, euro on both sides, and even the pound. Actually, let me show you what I think about the euro. Not on the daily chart. I believe it is weekly. Yeah, I changed my mind to bullish on the euro for today, actually. Here's why. Let's adjust this a little bit. It looks a little different on the Euro USD. But right in here, that was a pretty nice range. Okay. And the fact that we shot up through it, came back down, touched it, and then closed in a strong bullish. That gets me a little worried because I was bearish on this for the longest time. We'll see what happens with it though. I'm not really sure. Just because there was a range over here earlier, we can actually probably just bring it more over here to make it more realistic for today about your range. That's my thoughts though on the euro right there. But let's go back to your daily chart. The daily chart, it's a little iffy. It's been weird. I know Thomas is still bearish on it. I'm still bearish on the daily chart because we had that trend line that was coming up here and I was retesting it. But that range here could be argued that has a range, and that's a pretty massive fake out though. But it still does kind of meet that criteria. 1, 2, 3, 4, 5. Yeah, it's kind of iffy. I want to see like only about 5 or less candles before it actually pulls back inside to be considered like a real fake out. That could just be an actual down move, like legitimate, and then doesn't want to go down anymore as opposed to a fake out and continue up, because that's that right down here is the weekly last kiss area right there. So okay, so we got euro daily chart, we got YM 133. Okay, let's go look at that possible trap. Yeah, it could be a possible trap. Hard to say. We got a bunch of announcements coming out end of this week, next few days. Actually, tomorrow's gonna be some pretty decent ones, so we'll see what happens with that. 133. You have a massive range, to be honest with you. I mean, if you look right here, there's a one range, and look, it's pretty much awesome how it broke out here, then came back down. Bing, touched it. Bullish candle, buy, shot all the way up. Okay, then it came back down and broke back inside the zone here. Have a new zone we could be looking at. Yeah, that's just really choppy. The entities have been all over the place. I think, though, let's look at it. I think I have it in a range on a different time frame. I thought I had like a 2,000 tick. Let's see. Yeah, I have a range here on a 2,000 tick. That's what I had today. I was trying to get in on it, see what it does. I think it's the same thing on a 1,000 tick as well. There you go. That's your range. They're up on YM for 2,000 tick. And I'm pretty sure it was 1,000 tick. That's the same thing. I don't have those charts up anymore, but yeah, there you go. Okay, so we got YM on there. Does that help you for the YM on 133? It's a little choppy for me to say on that time frame, but larger time frames, yeah, it's a nice zone. Let's go ahead and look at Google. Google on a 4 hour. Oof, need to load some data here. Got 60 minutes. Let's check this to a 240 minute. Yeah, that's a nice range. I have no problem with that one. 2 touches right here. Right here we have plenty of touches. Nice fake out. Pull back inside. So yeah, definitely watch for this. That was a humongous gap up too. Jeez. Major gap up, man. I looked at Google for a while actually. Looking pretty good. Alright, so does that answer your question for Google? Alright, so that's you're good to go to watch that range on that one. Crude oil. Yeah, I was watching crude oil all day today. Actually, I was trading that range, to be honest with you. Ooh. Okay, let's change this to let me get out of that. That's really messy. Here's my crude oil range actually on 30 minute, just to give you an idea of the range I already had drawn today. I was watching it because it kept faking everyone out, but I was just waiting for it to break out, and it did right there. It actually touched my range, ironically enough, and that's on a 30-minute chart. So yeah, I had that drawn today. So on the hourly chart, that's a pretty wide range, but I would still consider it valid. Now I would probably hold off on that crude. See, this range right here isn't as convincing to me as this range right here was. This one sticks out way more than this. This one looks like it's just, you know, lower highs, lower lows still, but just really choppy. That's all, as opposed to right here, where it's pretty significant. Like it kind of sticks out. Like, hey, there's a range. That's kind of my filter. If I have to turn my head sideways a little bit, it's like, probably not a range. Alright, so we covered crude. 30 year, let's look at the 30 year. We got a 4 hour. Yeah, actually, a few weeks ago when I was in the trading room for Thomas, we were watching this range, see what happens with it. And it's funny that we're kind of up near that range again. So, I mean, I'll be careful with it. Because what I'm seeing, like what I believe, it's hard to say here. Let me look at the weekly right quick. So we broke out that range on that on the weekly chart, and we haven't quite retouched it. But what I see here really is it's kind of like an inverted head and shoulders here. There's your left shoulder. Here's your head. Here's your right shoulder, so I'm gonna wait out on it longer term, because if I do take a last kiss, I might take a last kiss off the weekly chart, because I mean we're at all-time highs. If it does legitimately break the downside, we could be in for a move that just falls to the floor. The inverted head and shoulders is what kind of messed me up with the range on the 240 as well. But I mean, I guess you could argue that this could actually be forming a head and shoulders. Here's your left shoulder, here's your head. And this could be a start of the right shoulder getting ready to form. So nothing really on there for right now. PCLN. If you have an area that's really intense like that and it shoots up after it's pretty case. Yeah, it may return. Like usually legitimate breakouts have a lot of follow through with it. You want to see it happen pretty quickly with follow through. Fake outs don't. They usually pull back inside pretty quick here. Oh, that looks like a nice one. Actually, I'll probably make this one a little bit more. Yeah, I consider that more the range right there. Personally, see how quick that was a fake out, pulled it back up. This right here, same thing, shot up, then pull back down. That's what you're looking for. These are the fake outs. These are what the fake out, the breakout strategies usually are coming up short. That's why we have that patience window verification to confirm that it is going to be a breakout. This right here could have been a decent one too. Yeah, this one would have been a massive one. Touch one, touch two, near misses. These are all considered touches. These are all considered touches, and then right there came up, and then there's your entry point right there. Fell to the floor. So we got PCLN 5. Let's take a quick look at our dollar yen, see what's going on with that. Hasn't quite made it, but hey, we'll see what happens. Again, that's one thing you just don't want to confuse. Not every breakout is the last kiss. Okay, just because it's breaking out doesn't mean, hey, I gotta wait for a last kiss. It's only there when it starts showing up, when you start seeing it maybe head back up there, and with strong momentum to the upside. Any other markets? What I was going to show you, yeah, British pound. British pound is one thing I'm looking at too. A lot of people are bearish on it and all that, but I'm sideways on this, man. Yep, that's me. Up at the top portion of that range, really. Just waiting for a breakout. Let me get the British pound actually. That's the dollar yen. Here you go. Still same thing. Let me draw this. There we go. Now you know what, I will pull in all that. There you go. That's my view on the British pound. You want a Nikkei? You want what, daily, I guess? And the Nikkei broke through a pennant on the weekly chart, if I recall correctly. Daily, I mean, daily it looks more bullish. The reason I say that is because on the right quick, let me pull up the weekly. I believe it pulled through like a pennant here. Yeah, so it broke the pennant, so I'm not sure. Could be a fake out, the pennant. Who knows? That brings me to another point here. Nikkei and the yen move together somewhat, or opposite to each other. Look at the yen right quick. That's like in a pennant as well. But what I have on the dollar yen, I actually have a range on the dollar yen. Trying to see what's going to play out with that. But for the Nikkei, yeah. On the daily chart, I mean, it is breaking out, so you could wait for a retouch potentially. And then that last kiss will verify that it's a true breakout of the pennant, because the pennant, by the time it comes down to retouch, it'll probably be retesting the trend line of the pennant that's broken. Just on a smaller time frame. Here's that pennant break, come back down, could retouch this. So we all good on this? Like, does it make sense? Pretty easy to enter, pretty easy to exit, pretty easy to find, pretty easy to draw. And again, don't want to rush it. It's all about patience. Wait for it to close, wait for it to verify. It can be done on any time frame, any asset. As long as there's humans involved in the market, you can trade it. Entering, it's all about, let's see. For entering. Okay, I'm trying to think. Actually, let's look at the Mexican peso. Look at this on the 120. Actually, I think I have it drawn. Actually, I got to enter on this. Here we go. This is the 240-minute chart. I had this zone drawn here, which I'll just go ahead and redraw. My entry, you wait for this whole candle. This is 4 hours. Okay, this is why I like the 4-hour chart, because I can wait 4 hours, and that's one day in the trading room. And that's, I can look at it about 5-6 times a day. I can go to the gym. I can see, okay, I might perform a last kiss. I can come back here at, let's see, 12 o'clock to check it out. That's why I like these, like on the 4-hour chart. You can really base your trades off like the time you want to. It's really convenient. But anyway, 4-hour chart. When it came down, I have to wait for this to close. It came back down, touched it. That's all I want to see, touch it. If it wants to go back in here deep, that's fine. Okay. And it closed right here near the high. The higher it closes to the high, the better. Or the lower it closes toward the low, the better. That makes it a lot more valid in my case. Since it's, the high up here is 76,670. It closed at 76,62. So like 8 ticks off the high. That's good enough for me. Can't ask for much better than that. So I would put a buy order a couple of ticks above that high. So say 76, 73, something like that. The market would have hit it. Okay, top of the candle. The market would have hit it. I would have experienced a little bit of drawdown. Okay, what's the low here? Low of 76.32. A little bit of drawdown, but the profit still is massive. Looking at over 200 pips of profit for like less than 100 ticks of drawdown. As soon as I enter in, I get this range here. I subtract these two numbers, divide by 2, put my stop somewhere like right in here roughly. Okay, that's worst case scenario. In case you fall asleep and it goes against you, it'll hit that. You can see over here it still actually used that stop, interestingly enough. So for some reason you held out and didn't close out at the end of the profit target and it kept coming down, your first point of contact to have closed out of it would have definitely been right as soon as it's closed here. Like, okay, time to get out. Minimize your loss. You wouldn't have gotten out here because it didn't close inside of it, so you're fine. But once it hit down here, then you would have been out for sure. Same thing for anything bearish. Actually, let me pull up. I think NASDAQ. It was really hard for me to find failed breakouts. I want to show you failed breakouts. But NASDAQ actually had one here in a sense. We were tracking this for a while in the trading room. There we go. So, nice breakout. Pretty valid one. As you know, NNCs have been all over the place for those of you in the future trading room. Came back up and look at that. It just hit that zone forever. It was just hanging there. Okay. Actually, let's go ahead and extend it all the way across. Now this right here, I would have entered on it. I legitimately would have entered in right at the low of that. So 33.53.50, I would have done 33.53, say. Put it at there even. Wait for the market to come down, hit it. Would have got in the trade probably. The low here, yep, 33.53. I would have sold at the low of the candle. And you can see what happened. It goes up. And I might have considered closing it out, but my break even stop, my emergency stop loss, roughly in this area. Okay. Now, I probably wouldn't close out of it because I saw weak momentum right here. I looked at momentum and I was like, oh, it's pretty weak. Okay, so it's not having a lot of follow through, so I would have kept it open. You can throw that factor in there as well if you want to. Just the more you trade it, the better understanding you kind of get of it. So I wouldn't have closed out of it, even though it did close inside of it. You can see shortly thereafter it pulled back down. Try to make new and lows, didn't quite do it. Right here, I still wouldn't have closed out of it. But as you can see, when it was down here, this thing exploded. And if you were watching it during the day, you would have been able to manually close it out. But in case you were like, I'm still short and you're going to the gym, whatever, this is the worst loss you would have got. That's your emergency stop loss. That's what it's there for. In case something freak like this comes out, it hits your stop. And that's the worst case scenario. But if you're watching it, you see it come up here, you see momentum start to pick up. Right here, you know a news announcement is about to come out. You'll know how to get out of it pretty quickly. You'll see that there's a major announcement coming out. Go ahead and close it. No problem. And sure enough, it broke through. Then right here, you actually could have gotten in on it again if you wanted to. It broke out, came back down, touched it. You could put a buy order in right there, and then rode that out the top. No problem. But then again, it came back down right inside of it. It's inside the zone again. Makes sense to everyone. That's the only one I can really find that's like a failed breakout. I looked through charts for a long time because I want to show you examples, but that's the only one I can think of. But even then, not really a fail, I guess. So if we're all good, then we'll go ahead and close it out for the night. For those of you in the trading room tomorrow, we'll look for some of these breakouts and all that kind of stuff. Look for some of these ranges. You can ask questions then too, like which ones are possibly informed. Slides, I can try to send those out tomorrow. And the video available, I'll try to get it uploaded as soon as I can. But hopefully that will answer any questions. I know a lot of people liked it, but they were unsure of how to enter it. Keep in mind, again, especially in futures, your risk reward is going to be terrible. So if it hasn't flipped your boat and you don't want to be a nervous wreck, don't trade just because I trade it. It's just an option. It could be your handy dandy notebook. It's just a tool that's there if you want to use it. Practice with it. See what happens. Look at historical data, back test it, paper trade it, candle by candle in the past. See if it actually does work out in your favor and get confident in using it. If you're not confident in something that doesn't match your personality type, it might not work out for you. So just because I do it doesn't mean everyone else has to. Especially that risk reward stuff. You'll be looking at risking a good bit for not a lot, but a lot of times it falls through. That psychology of the market. So hope everyone had a good time. Hopefully you learned something, and I will see a lot of you tomorrow, actually, in the trading room. So see you all then.